Look, your financial advisor is quietly siphoning $500,000 from your net worth through a 1.5% fee that sounds small, but in reality, it kills your compounding. I am going to show you why your current wealth management is actually a wealth leak. I mean, it's basically an invisible hole in your bucket. You see, most people view a 1 or 2% fee as just a convenience charge, right? But when you compound those numbers over 20 or 30 years, you aren't just paying for advice. You are forfeiting nearly a third of your terminal wealth. You are essentially working for your advisor, rather than your money working for you. We are moving away from passive hope. You know that strategy of just hoping the market goes up while someone else clips a coupon off your hard work? And we're transitioning into structural alpha. In the world of high-scale business, we don't leave growth to chance. We architect it. Structural alpha is about moving beyond simple index tracking and building a framework that prioritizes tax efficiency, risk-adjusted leverage, and asset protection. By the end of this video, you will understand how to treat your capital like a high-performance business entity using the 3-tier portfolio. This is the exact framework used by family offices to preserve and scale 8-figure fortunes, and I am going to show you exactly how to apply it to your own journey. I will give you the tools to manage $1 million plus with more precision, more control, and significantly more profit than any traditional advisor ever could. It is time to stop being a client and start being the architect of your own wealth. Let's look at the numbers because, in the world of wealth management, math is the only truth that matters. Most people view a 1% or 1.5% advisor fee as a standard cost of doing business. It sounds small, almost negligible, right? Especially when you're looking at a 7-figure portfolio. But when I analyze a portfolio, I look at the velocity of capital. How efficiently your money moves toward your end goal without being diverted. If you have $1 million and your advisor takes 1.5%, and then places you into actively managed funds with an average expense ratio of 0.5%, you are losing 2% of your total capital every single year before you even factor in taxes. On the surface, you might think, I'm still keeping 98%. I mean, you're wrong. You aren't just losing 2% of your money. You are losing 100% of the compounding power that 2% would have generated over the next 2 decades. Think about it this way. Over a 20-year horizon, assuming a standard 7% annual return, a $1 million investment should grow to roughly $3.8 million. However, once you strip away that 2% in combined fees, your ending balance drops to approximately $2.6 million. You just paid $1.2 million for the privilege of having someone else manage your money. I mean, you took 100% of the risk, but you allowed a middleman to capture nearly a third of your total wealth creation. This is the hidden cost of mediocrity. Your capital is operating at 80% capacity when it should be at 100%. When I talk about shifting to a 3-tier model, I'm talking about reclaiming that lost $1.2 million. By optimizing for tax efficiency and using a risk parity framework, where we balance the portfolio based on volatility rather than just asset classes, we ensure that every single dollar is pulling its weight. We stop the leaks and start treating your portfolio like a high-performance engine. But look, maximizing your math is only half the battle. To truly manage $1 million plus with precision, you have to understand exactly where that money lives within your tiers, because one specific bucket is where most do-it-yourself investors fail during a market correction. To build this architecture, I divide your capital into 3 very specific buckets. See, it's all about structure. Tier 1 is the foundation, representing 70% of your total portfolio. This is your bedrock. Look, I don't want you chasing the hot stock of the week here. It's a trap. Instead, we automate this into low-cost total market ETFs like VTI for US exposure or VXUS for international diversification. This gives you that 8% to 10% historical base return, you know? The goal for this 70% isn't to be clever, it's to be consistent. You aren't looking for a home run here. You're looking for the compounding power of the entire global economy. Then we move to Tier 2, the growth engine. I allocate 20% here, right? This bucket is for assets with higher velocity, such as cash-flowing real estate or business equity. While Tier 1 is passive, Tier 2 is your hedge against inflation. It's designed to provide a higher yield and better tax advantages than the stock market, ensuring that your wealth isn't just growing, but accelerating through active leverage. Finally, we have Tier 3, the moonshot. This is your 10% high alpha play. This is where I look at asymmetric risk, crypto, angel investing, or even scaling a high-margin side hustle. Because this is only 10% of your net worth, you can actually afford to be aggressive. If a moonshot fails, your foundation remains intact. But if it hits a 10x or 100x return, well, it changes your entire financial timeline. Now, the secret sauce to managing $1 million plus without an advisor is the 6-month rebalance cycle. Every 6 months, I evaluate these tiers. When Tier 3 experiences a massive run-up, which often happens in volatile markets, I don't just let it ride. I mean, that's how people get burned. I harvest those gains and rotate them back into the foundation. You are systematically taking your high-risk wins and locking them into forever wealth. This architecture creates a one-way valve for wealth. Money flows from high alpha wins back into the stability of the foundation. However, even with this structure, there is one specific detail regarding Tier 2 that most investors miss, and it's the primary reason portfolios of this size suddenly stall out. Let's run the simulation. I want you to imagine for a second that you're sitting on exactly $1 million. Now, under this architecture, your foundation, Tier 1, is holding $700,000 in low volatility assets. You know, things like index funds or cash flowing real estate. Tier 2 has $200,000 focused on aggressive growth. And Tier 3, your moonshot bucket, has $100,000 spread across those high asymmetric bets, right? Now, let's say one of those Tier 3 bets, maybe a pre-IPO share or a concentrated tech position, hits a 5x return. That $100,000 just turned into $500,000. Look, this is the exact moment where most investors lose their minds. I mean, they get high on the dopamine of a massive win and decide to just let it ride because they honestly think they have the Midas touch.
I don't want you to do that. Instead, I want you to execute what I call the structural alpha move. You immediately sell that original $100,000 principal and move it straight back into Tier 1. Now, your foundation, the money that ensures you never have to work a 9-to-5 again, has just jumped from $700,000 to $800,000. You've locked in a permanent increase to your financial floor. You've moved the goalposts of your security in the right direction. So, what about the remaining $400,000? Well, that is now house money. You leave it in the moonshot tier to continue its exponential run. Look, if that asset eventually goes to zero, you haven't lost a single cent of your initial capital. But if it goes up another 5x, you simply repeat the process. This creates a psychological and financial feedback loop where you are systematically harvesting volatility to build an indestructible foundation. By doing this, you are scaling toward $5 million while your downside risk actually decreases over time. You are engineering a one-way valve where wealth flows in, but it can't easily flow out. However, even with this feedback loop in place, there is a hidden friction point. If you scale this way, you will eventually hit a ceiling that has nothing to do with your investment picks and everything to do with how you've structured your growth assets. In fact, there is one specific detail regarding Tier 2 that most investors miss, and it's the primary reason portfolios of this size suddenly stall out just when they should be accelerating. Look, that ceiling I mentioned
isn't actually a lack of capital. It's a lack of control. When you reach this level, you realize something uncomfortable. Your advisor's primary job isn't to make you rich, it's simply to keep you as a client. By locking your assets in a black box of proprietary funds and diversified models, they create a dependency that literally costs you hundreds of thousands of dollars over your lifetime. But now, you have the blueprint to break that cycle, fire your advisor, and reclaim your compounding. This is your new mandate. You are no longer a passive observer of your wealth, just waiting for a quarterly phone call to tell you how your own money is doing. From this moment on, you are the CEO of your capital. Let's look at the raw data for a second. If you're managing $1 million and paying a standard 1.25% management fee plus internal expense ratios, you're easily losing $15,000 every single year. Over 25 years, assuming an 8% market return, that small fee eats nearly $1.1 million of your potential net worth. That is the staggering price of being a passive observer. Your next action step is non-negotiable. Audit your current fees and map every single one of your assets into these 3 tiers today. If an investment doesn't have a clear home in your architecture, it is likely dead weight dragging down your velocity. If you want to scale faster, you need to master the allocation, not just the saving. True wealth architecture is about precision and the relentless pursuit of efficiency. Subscribe for more high-level wealth scaling strategies to ensure your portfolio remains a fortress. I'll see you in the next one.